both the FDIC and the Federal Reserve just published their annual look at what examiners are citing and what consumers are complaining about. The FDIC did it through its Consumer Compliance Supervisory Highlights, and the Federal Reserve did it through its Consumer Compliance Outlook. Even if you're not supervised by either one of these agencies, you really want to check it out because the same laws apply to banks, credit unions, mortgage company on many of these things. And these are amazingly important compliance risk signals that we all should be watching. So let's start at the top with the big picture, because these trends over the last 3 years really tell a really interesting story. So the FDIC, to start out with, has conducted around 800 exams in 2024. That is down from the 900 that they conducted in 2023. But the violation count, they were still steady at around 1,275. That means that examiners are finding just as many problems with even fewer trips that they have to do to institutions. On the complaint side, both agencies saw a pretty notable surge. The FDIC closed over 26,000 complaints. That's up from 14% from the year before. While the Federal Reserve numbers were even more striking, they investigated around 8,300 complaints. That's an increase of 39% from the prior years. So complaints involving third parties, we're going to want to note that they were increased at the FDIC around 13%. So again, we're going back to third parties not only being a vulnerability for your data, but also potentially violating regulatory obligations and causing consumer harm. And the financial consequences are pretty bad when this happens. The FDIC reported that they assessed $5.6 million in civil monetary penalties, and institutions also had to pay around $33 million in voluntary restitution to affected customers. And that is up from around $7 million that was paid the year before. So a notable increase again. Now, before I run through the top violations, I want to flag something really important about how to read this data, because I was really thinking about it and I'm like, if I think about this, I think it's important for everyone to know that we all know regulators use a risk-based exam approach, meaning we know that they spend most of their time examining regulations that carry the greatest potential harm for consumers, right? So when we see things like TILA, RESPA, and flood insurance at the top of the list year after year, that's partially because those are the areas that the examiners are digging in the hardest. That doesn't mean we're just nailing everything else and we're just doing so good on deposit regulations or privacy laws. It means that everything else is not getting the same level of scrutiny. So that's a problem because examiners may not be paying attention to it, but like we talked about, litigation, private plaintiffs, state banking associations, attorneys, state attorney generals, they may be paying attention to that. So this information we have from the FDIC and the FRB plays double duty. It tells us where our compliance needs to be tight, but it also tells us where examiners are pointing our flashlights, right, when they come into your institution.